Welcome to the HMO Matters podcast channel. Today, we're going to talk about mortgage valuations and in particular, the way banks value completed HMOs for mortgage lending purposes. Now, it's a question that often comes up, and joining me today is property professional Lisa Orme, whose business Keys Mortgages specialize in HMO lending, and she's going to help us unravel all of this. So welcome to the podcast, Lisa Orme.
Hi, Grant. Thanks for having me along.
Now, I know of you and other people's might do as well, but for those who don't know you, Lisa, perhaps you could just give us a synopsis on your background and how Keys Mortgages came about.
Okay, so I'll try and do this in about a minute. So I was a forensic scientist for 15 years. And I was given a copy of Rich Dad, Poor Dad, which is a very popular book amongst the property investor community. Myself and my then fiance, now husband, went off to Australia for a long holiday. I chucked it in the case, read it while I was out there, couldn't put it down, told my husband to read it. And it was property that absolutely hooked us in that book. Interestingly, I've reread it again a couple of times, and there's not that much about property in it, but it's funny how something grabs you. So literally on our way back, we were making plans about how we could get into property. We started our own letting agency, and we quickly decided that that was too much like hard work, and the people that were making the money were the landlords, not the letting agents. I beg to differ on that one now, but we sold that. Then we sold an endowment policy that was badly performing, bought a property, renovated it, sold it, and actually doubled our money. So then we went off and bought 4 properties off plan from a developer. This is going back 20 years. And that was the start of our portfolio. We then did 200 property deals over the following 5 years or so. Sat back a little bit, did lots of buy and sell, lots of development and building our portfolio and new build. And then the credit crunch hit in 2007, and that was the year we also got married. And then so we sat back a bit. One of our builders said to me, oh, I think you'd make a good mortgage broker. So that was it. We did all our qualifications in 2009, and I launched Keys Mortgages. So that's been running for the last 12, 13 years. And because of my background in property, we specialised with investors, portfolio landlords, limited companies. HMOs really intrigued me. And at the time of launching the brokerage, everybody was getting into HMOs. So I did a lot of research on understanding them, the rules, the requirements, licensing, planning, all of the things that we're going to come on to. And ended up just specialising in those, and got a reputation with that, with the lenders and also the press. So I've often been asked to comment on HMOs. I help lenders with their valuation policies and methodology, and that's just expanded those skills even further. So I've got a team of brokers that do write pretty much all of the mortgage business these days for me, and I'm just working on some other projects. So I'm doing things like this, and I've got a whole other brand called Mortgage Mama, and I'm just giving out loads and loads of free information for investors and home buyers. Just Google me. I've got a new podcast that we've done, and I'm also doing consulting for other mortgage advisors and property investors on restructuring portfolios, exit strategies, growth, that type of thing. So that's me in a nutshell.
Wow, so that's quite some background, and I guess that's keeping you very busy, Lisa. I guess what's of interest to me is to go into mortgage broking with the foundation of having all that experience behind you, and in particular then coming into the credit crunch and learning all the lessons from that perspective. I guess in terms of things like risk management and being sensible and looking at worst case scenarios, that's going to be second nature for you.
Yeah, absolutely. I mean, even just the forensic science background, you know, it's all about compliance and caution and that type of thing, and problem solving, which is the thing that I absolutely love. But I think it is really interesting when we're seeing people today complaining about rates that are in the mid-3s for HMOs and limited companies. And I'm looking at old mortgage documents with single lets with rates in the 6s and 7s. You know, so you know, and that's not that long ago. And you know, while rates are where they are and things are low and probably likely to stay that way for a good time, I don't think we should underestimate that it's you know, it's not more than a decade or so that we were seeing rates with 6s, 7s, and us older types can remember double-digit figures as well. So
yeah, I know that's completely right. I mean, I didn't enter property seriously until 8 years ago, but I did have a buy to let from the 90s, and I remember rates in 8, 9, could have even been 10, and we just take low rates as for granted now. And yeah, I think you're right. I don't think there's any scope for them to go that high, but the point is we don't know, do we? And you know, we just can't take what has happened currently for granted. I thought a good place to start, Lisa, is maybe just a description of what an HMO actually is, because I don't know about you, but when I ask that question, if I ask that question to 10 people, I'll probably get 10 different, 10 different answers. My perspective of it is three or more unrelated people living in the same property. So if you've got a couple and a separate lodger, that's an HMO. But if you've got a couple and one of the couple has a brother or sister or other relative, then that's not an HMO. Another example could be the student house, can't it? Because I hear people commenting, oh, I've got a student house, how do I get finance? And in fact, a student house is, of course, a student house if there's students living there. But if there's 3 or more of them and they're unrelated, it is very clearly an HMO. So that's just a couple of examples I can give. But as far as lenders are concerned, I think that's only part of the story, isn't it, Lisa?
Oh, definitely. And again, this is definitely back to if you ask 10 lenders or 10 mortgage brokers, you'll get 10 different answers on what's classed as a HMO where lending's concerned. So you've got the official description, which is what you've just explained. And then you've got, you know, sort of licensing, planning, all of those sort of things, which we'll come on to. But for lenders, it's all about their criteria, their policy, and also their funding lines. And the funding lines often determine what they can and can't lend on. So if we take some of the buy-to-let lenders, for example, a number of them would lend on a property with 4 sharers and regard that as just ordinary buy-to-let mortgage, and what we'd sort of call vanilla in the marketplace. But there are some keys with that. Typically, they are looking for all 4 to be on the same tenancy. Typically, there still needs to be a separate living area, a living room or communal room at the property. And often they don't want locks on doors, and the property can't be altered in any way that's taken it away from being a family home. So what the lender's looking for there is essentially that if they had to take repossession of the property, that they're going to be able to sell it back into the marketplace as a family home. But that's just the start of it. We then start getting into more complex territory. So Birmingham Midshires, for example, will allow 5 tenants, must be on a single tenancy again. They're okay with locks on doors. They're okay if you don't have a communal space, but the property still needs to look like a single family home. But we see an awful lot of people who are placed with Birmingham Midshires, for example, with HMOs with individual tenancies, and they don't actually allow that. So wish I had £1 for every time I've seen that. And then we start moving into other lenders. Skipton, for example, they will allow for individual tenancies. Leeds will actually insist on individual tenancies for their single let. Then we start to get into proper HMO territory. A lot of the lenders will top out at 6 rooms and don't want any more, or 6 occupants, I should say. And the reason is that when you've got 7 plus, you start going into planning permission. So a lot of the lenders want to top out at the not having requirements for planning. And then you'll have, and they'll often regard those as small HMOs. Then you'll have some lenders that will go small and large HMOs, so 7+ or 8+ is regarded as a large HMO, can be individual tenancies, locks on doors, some will allow kitchenettes, some won't. When you go into full-blown commercial territory, up to 20 rooms, 30 rooms, on a sort of more commercial basis. So it's absolutely crucial to understand the number of tenants that you've got in the property, the setup of the property, the type of tenancy agreements, if you've got individual tenancy agreements or a single tenancy agreement, also the type of tenant. It's not a case of it's a HMO, so this lender will do it. A lot of lenders don't like vulnerable tenants, for example. They don't like rent-to-rent arrangements or arrangements with the likes of Serco, asylum seekers, ex-offenders. Some will only allow students, don't like professionals, some don't like students. So it's really important to understand all of these different aspects and really make sure that you're on the right finance for your property, your tenant type and your circumstances.
That's very good advice. And I think just adding to that, I think it's also quite important, certainly what I've started doing from past experience relating to Birmingham Midshires, which I'll come to in a few seconds, but I also now read my mortgage offers and I read the terms and conditions. So I had a situation a few years ago where I was advised by a mortgage broker that it was okay to go with Birmingham Midshires. They allowed up to either 4 or 5, I can't remember the detail, but they allowed up to 4 or 5 people in the house, and that was fine. But what they didn't tell me is that those individuals had to be on the same tenancy. It couldn't be a situation of them on different tenancies. And mortgage offer came through. Luckily, I read it, and we basically had to go back and find alternative finance because it wasn't going to fit. And the mortgage advisor, I don't think they were being untoward. I just don't think they understood. I don't think they necessarily knew. And it's just important to really check everything.
Yeah, it's Birmingham Midshires for HMO lending, the bane of our life really, because when we do a search for HMOs on our sourcing systems, you can tick it's a HMO, and Birmingham Midshires come up in the search, and they will always be cheaper. They're going to be cheaper than your Precise and your Kent Reliance and all of those proper HMO lenders. And as you say, unfortunately, if the broker, and the client's not expected to know, doesn't understand, and there's the cheapest lender come up at the top, then the broker is going to select them. They're significantly cheaper than the other HMO lenders. And I'm doing exactly what you've just said for a client right now who was on who'd got individual tenancies on a HMO, 5 tenants, which is fine, but individual tenancies, and didn't realise that he couldn't use Birmingham Midshires. So that's exactly what we're doing now in switching him over to a product that is acceptable to the property, is that you don't want to be breaching mortgage terms. It should never be an option, and also it could potentially invalidate insurance policies, all sorts of things that could come back and bite you later. So it's really, really important to broker and to client to make sure that you're on the right mortgage. And interestingly, when you say about checking the offer, it's surprising how many offers and illustrations don't actually mention that it's a HMO product. So to lenders, they've often just got codes, or it'll be specialist lending and things like that, and it won't specifically say it's a HMO product. And we had this with another client where they contacted the lender about doing a product transfer, and it said it was a HMO, and the lender came back and said, no, it's not a HMO, the product's not a HMO product. So they contacted me because we'd actually done the mortgage, and we went back over all of our paperwork. Luckily, we'd got everything, and it was a paper-based application with the lender, and you actually selected the product, and it was a HMO product, but nowhere on the documentation does it say HMO. But interestingly, at the very top of the application form, we'd handwritten in HMO application because it was a standard application form. So we went back to the lender and they acknowledged that, yes, it was actually a HMO product at the time. It was just that they didn't offer it now. So, yeah, it was a bit of a panic there for the client and then for us. But luckily, we'd got the paperwork to back it up, and the lender did back down and say, yes, it is a HMO product. and confirm that, but quite often your offers and illustrations won't actually say the specific words HMO. So it's really important, again, to, if you've got any doubts about that, go back to the broker and just make sure that they have submitted it as a HMO and that it does fit your property type.
Completely. And I think most mortgage advisors will do that, but it's just really important just to be aware and understand all these pitfalls and everything else, because at the end of the day, it's you that's going to come back and bite, and not the mortgage advisor. So I think that's great advice, Lisa. Moving on from that to mortgage valuations themselves. So if you buy a house and you're living in the house, or you buy a property and you're letting it out as a standard buy-to-let, the lender will instruct a surveyor. The surveyor will come around, have a look at the condition of the property, make sure building regulations and planning is in place and that it's up to health and safety standards and everything else. And they will also have a look at comparables locally, for sold, for sale. They may have a look at trends in the property market. Is the market very strong? Is that valuation likely to hold itself, and those sort of things? So it's relatively, compared to an HMO, it's relatively simple for the valuer to come up with a valuation based on bricks and mortar, so that you can then go ahead with the purchase and put your tenants in or live in the property. It's different with an HMO for a myriad of reasons, Lisa. So can you step us through how banks go about valuing an HMO property and why it's different from a valuation perspective?
Yeah, definitely. The first things to consider are whether it makes a difference if the property requires planning or not. Licensing, no, that doesn't make any difference to the value of your property. And the most important thing I can stress, and I do stress over and over again, is licensing is completely different to planning. Two completely different departments. Just because you've got a license doesn't mean you would get planning, and just because you've got planning doesn't mean that you would get a license. They're completely different things. So right now we're going to talk more about planning. So firstly, we've got sui generis planning, which is where there is 7 or more occupants will always require planning permission or proof of existing use. Then we've got Article 4 areas. Article 4 is where the right, the automatic permitted development right to let your property as a small HMO, that's 3 to 6 occupants, has been removed. So typically it's where the council wants to monitor the number of HMOs that they're allowing in an area, often around universities and things like that. So sometimes it's linked with conservation areas. And the idea is to limit the number of HMOs in that area. So they have to go and get planning, or again, prove existing use. And by the way, proof of existing use is either prior to the Article 4 being introduced or 10 years. It's not 4 years, which is what applies to many planning permitted use, such as conservatories and things like that. For HMOs, it's 10 years, not 4, or proving that it was a HMO prior to when the Article 4 was introduced. So for valuation purposes, if we consider ordinary properties without any planning requirements, so they're outside of Article 4 and they're 6 occupants or under, essentially you are going to struggle to persuade a valuer or a lender that that property is worth any more than its bricks and mortar value. Okay, if you tip the property upside down, empty the tenants out of it, empty all of your nice furniture and your IKEA stuff and all of that for your students and your tenants, you've got a bricks and mortar house. So trying to justify that the property is worth any more with commercial valuations and yield valuations is always going to be a struggle. So essentially, if you've got 3 to 6 occupants, it's a normal family home in without anything fundamental done to the property, it's going to be valued at what next door has been valued at. Now, you might get some uplift if it's a really nice refurbishment, but that's no different to a property that you've bought as a family home and done some work to. So it's based on its bricks and mortar value, typically. Now, if you've taken that property and let's say it's still 6 6 occupants, but you've done a double story extension to the side, a double story extension to the rear, you've got a loft conversion, you've got en suites in every single room, you've got kitchenettes in every single room, but you've still got 6 occupants, then you're starting to go out of the realms of a family home. So you could definitely start to see an uplift in the value there. And then how that's valued will be several fold. So also in terms of properties that are clearly not single family homes, so your 7+ that have required planning permission, you're going to start getting into more commercial valuations, because it's going to be difficult to value that compared to the 3-bed semi next door. So the way that valuers will look at this is typically using 4 different metrics, and also this is what we use. And invariably, subject to, there's always the exception that proves the rule, these figures actually normally end up within about 10% of each other. So the 4 metrics are market value. So this is bricks and mortar, but as I said, can end up being problematic for properties that aren't like all of the neighbouring properties anymore. Okay, so but market value will always be taken into account, and that's what would the valuer expect the property to sell for in a reasonable market, if it was put on the market for sale. Then we have total spend. This is one, surprisingly accurate, and surprisingly unsurprisingly for us, but surprisingly for a lot of investors, the most common used, and that is, what did you buy the property for and how much did you spend on it to get it into its current condition? The reason valuers like to use that one is that they're saying, well, I could go and buy next door in the same condition that this one was when you bought it, spend that amount of money, and I've now got the value of that property. So if you bought it for 150,000, you spent 100,000 on it, they're probably going to come back with a valuation in the region of about 250. As I say, there's always the exception to prove the rule, but we often find these numbers are fairly accurate with the valuations that we see come back. So that's the total spend valuation. So all the valuer is saying is if I went and bought the same property and spent the same amount of money, that's how much that property is now worth. Otherwise, why would I go and spend more money to go and acquire the same thing? I know you've got time, you've got the effort involved in doing the works, but that's a general principle. The third one is room rate. So this isn't about how much the rooms rent for, this is the rate that rooms sell in HMOs. And again, this is surprisingly accurate as long as you compare apples with apples. So if we take a good quality refurbished property, let to professionals with all en suites, look for similar properties in the area, divide the value or the sold price of those properties by the number of rooms in that property, and you get a value per room. Multiply that back up with your property and you'll get a rough idea of what it will be like. And that's actually a really quite an accurate method of how HMOs can be valued. I've not seen many valuers use this actually in their valuation reports, but we find it a really good marker to indicate what a property might actually sell for, or value up for. And what you can't do, as I say, it's important to have apples with apples. So if you've got a very poor property in a poor part of town, let to benefit tenants, or with no en suites, one shared bathroom amongst 4 or 5 people, poor facilities, no parking, and that's giving a valuation of say 20 grand per room, and there's 14 rooms crammed into the property. You can't compare that to a lovely 6-bedroom property with all en suites that's just been completely refurbished. So you've got to compare apples with apples, but if you do, it's a really good marker of what the property might value up at, and we find that surprisingly accurate. The final metric is what people call the commercial valuation, the yield valuation. And there's 2 different ways of doing it. You've got the multiplier method and the division method. So the division method is what valuers will typically use, where you take the typical rents on similar properties in the area, divide it by the yields they would expect to achieve, and that will give you your valuation of the property. And then you've got the multiplier method, which is the one that I actually prefer and I generally find is a bit more accurate. And this is that you take your annual rent. When taking annual rents, by the way, it will always be net. So valuers will typically take off 25% of the gross rent to cover voids, maintenance, repairs. So if we take the net rent and then take it annual, multiply it up by 12, and then multiply it up by what I call the multiplier, and it varies, and it's really just a gut feel. So a lot of people use the 10 times multiple. Traditionally, some of the commercial lenders use that to take the net rent, multiply by 10. That will give you a rough idea of what the value of the property is. It's not a bad halfway house. I tend to find 9 is probably about more where most come in. If you head to London, Cambridge, Oxford, places like York, you will find that multiple will increase. So 12, 13, 14 times if the property's in really great condition, just been refurbished, en suites, professional tenants, working tenants. As I say, that could be up 12, 13, 14 as a multiplier. Again, if we go the other way, Northern Terrace converted to HMO for benefit tenants, shared bathroom, shared facilities, not in the best condition, just a cheap bed put in each of the rooms type thing, then that might be down at 4, 5, 6, 7 times income multiple. And then if we take all of these 4 together, invariably you will find that they're actually all very close, and it can give you an idea. And what we typically do as brokers is, let's say those figures come back at 185, 180, 190, 195. I'll be saying to the client, let's stick it in for 200,000 and hope we end up around about the right figure. Okay, if they want us to put it in for 250,000 or even $1 million, that's fine. It's them that's got to pay for the valuation fee. It's not us. But we're just being realistic on where we expect that valuation to come in. Similarly, if all of those figures gave figures 275, 280, 285, 290, we're probably saying, let's stick it in for 300 to 325, maybe try 325 and hope to end up somewhere back around the 300 mark. And we do find those figures are, as I say, all generally within about 10% of each other. The exceptions that you'll find, because they all break the rules, is in the expensive towns and cities, London, Cambridge, Oxford, York, Harrogate, places like that. Believe me, you do not want a yield valuation in these places, okay? Because the bricks and mortar valuation will be higher. The amount of times I've argued with an investor where they've gone, I want a commercial valuation, and I'm like, no, you don't, because there is actually more value in the bricks and mortar, in the land that it sits on, than there is in the return, the commercial return on the property. So in those places, you definitely don't want a commercial valuation. You would want a bricks and mortar valuation. The other extent is where you have 70, 80, 90, 100 grand Northern Terrace that's been chopped up and rented out to 6, 8, 9 tenants, and then trying to get a commercial valuation on that. You're going to struggle to get a commercial valuation on those, because essentially the valuer will take the view, I can go and buy next door for 80 grand, spend 20 grand on it and get the exact same result that you've got. There is no way that just because you've crammed in 7, 8 or 9 tenants that property is suddenly worth £200,000. So those are the exceptions, but generally we tend to find that those ways to value a property do work out pretty accurate in the vast majority of the country. And the other thing that I'd say is, if you get something that's clearly not a family home, or could be conceived as a family home or perceived as a family home, I should say, in any way, like office buildings that have been converted to a HMO, or a factory or an ex-commercial unit or something like that converted to a HMO, the valuer will invariably go with something like a commercial valuation on that and use the yield and try and find comparables for rooms in that area, because it's just so hard to compare to. So I hope that gives a rough idea of how we would put our numbers together and then hope that the valuer agrees with us.
Yeah, that's very interesting, Lisa. My takeaway from that is it's not really what's happening under the bonnet, so to speak. So if you've got two similar properties and one has 10 tenants in it, paying £400 a month, that is not going to get a higher valuation than the same property with 5 tenants in it, paying the same amount. Clearly, the valuations are going to be the same based on bricks and mortar, and what's happening under the bonnet is irrelevant in terms of income. But if you have a larger residential property that clearly resembles a house with comparables close by versus an office maybe in a city centre location that could be above shops, that's been converted to residential where there are absolutely no comparables, that is going to be more on the side of a commercial valuation. So I think it's important for anyone listening to the podcast to understand that. And the other thing you mentioned, which I really want to highlight as well, is if you are going to get a commercial valuation, I often hear, oh, I've spoken to this person, I spoke to my mortgage advisor, and I can get a multiple of 9. So my question is 9 times what? Oh, 9 times the rent. Oh, is that the gross rent? Net rent? Oh, I thought it was the gross rent. So, and clearly it's not going to be the gross rent. Yeah. And even if it is the gross rent, that may be favourable for you, but it may not be favourable for you in more affluent areas where property prices are much higher, such as London, Cambridge, Oxford, where you suggest, because the disparity in the valuations versus rental income is so much greater. But it's a common misconception that I come across the whole time.
Yeah, definitely. They're always going to look at net rent with HMOs and rooms. If it's a multi-unit block where you would rent out the property, even if it's a multi-unit, you would still rent out the individual units without bills included typically. And therefore they're happy to look at the gross rent. But the fact is that you are including bills, maintenance, repairs, voids with HMOs, and the valuers are always going to knock off a good percentage for that. And typically we see 25% knocked off the gross rent, and that can make a massive difference to your valuation if you've unfortunately gone and worked off gross rents. So if you always work off net rents, knock off 25% if it's in a HMO, bills included. We've even had scenarios where for whatever reason bills haven't been included, and we still struggle, even when we can prove that, persuading a valuer to work off gross rents even where bills aren't included, because they still say that you're still unlikely to ever fully let a HMO all the way through, every single room all the way through. You will have higher maintenance, you will have higher repair bills. So even if the bills aren't included, you're still going to struggle to persuade a valuer that they're going to accept the gross rent. So always knock off 25% off your gross rents and then use that. And if you want to work off a 10 times multiplier, just to give you a ballpark, most places it's not a bad idea. As I say, I tend to find it's more at the 9 rather than the 10, but it's not a bad idea to give you a rough ballpark figure, but certainly don't rely on it if you've got to pay investors or whatever back out of your funds. That can really backfire. And it's the other thing that I wanted to point out was that we've seen examples even with full-blown proper commercial conversions where the valuers believe that they are worth more, the properties, but they have lending parameters. So a good way is with an example. So we had a gorgeous Georgian property converted to a 14-room HMO with a client, absolutely stunning property, marble throughout, all of this sort of thing, professionals, fantastic location. Spent £300,000 on the works, bought the building for £350,000. So we've got a total spend there of £650,000. The valuer's comments, and I kept them because I think it's a really interesting one, was, there is no doubt this is a superb conversion to supreme quality. the property as a building would have no doubt valued at in the region of 1 to 1.1 million. However, for lending purposes, I place the value at 650,000. Okay, so that's really interesting that they've gone back to this total spend valuation, which was the purchase price and the cost of works, because what you were saying was exactly what I explained earlier. What the property would sell for on the open market, he's saying, yeah, it's a fantastic conversion. Some investor with some money to spend would be more than happy to pay £1 million for this property. But in terms of what it's worth to a lender and to me as the valuer, I could go and buy the exact same property if it became available for 350,000, spend 300,000 on it, and I've got a property that's now worth 650 in terms of total spend. So why would I go and pay 1 million for this when I could spend 650 and get the same thing? Of course, the opportunity, it's not saying it's available, and it's not saying somebody wouldn't buy it for 1 million, but that's just the way valuers think. So I think that's a really good example that even the valuer actually commented that the property would be worth 1 million to 1.1 in the open market, but for lending purposes he valued it at 650, and that was what the valuation was based on, and that was what the lending and the loan was therefore based on.
Yeah, I think that's a really, really salient point. And a lot of people who come into HMOs, they almost want to have their cake and eat it. And I think that's just through a lot of misinformation through various property forums, training courses, and that type of thing. But for me, and I've had quite a lot of experience in buying residential properties and extending them up into the side and then letting them out as HMOs. And for me, the value I get from that is long-term sustainable income. Very rarely have I done one of these projects and got a valuation which is giving me a lot of my money back, leaving little in, and also giving me the benefit of long-term income. It just doesn't really happen in reality unless you're in the right place at the right time with the right surveyor and those sort of things. But it's more that long-term income that we're looking at, unless of course you've done a lot of work. So if you have taken that office and you've had to go through the planning process, maybe raising bridging finance and taking time for planning to come through, instructing a contractor, doing all the work and everything else, in that situation you might well get a very high valuation, have all your money out, and have the enjoyment of long-term income. But of course, in that situation, you've taken on a lot of risk and you've done a lot of work. And you mentioned when I spoke to you previously about the scales, and the more you put it on one side, the more you get from the other. And I think it's really good advice just to think about that in terms of input and output and those sort of things.
Definitely, I think everything there. I think if we think about investing just in its simplest terms, not even property investing, just in stocks and shares and the stock market, we all know that the higher returns come with the higher risk. It's, that's invariably the case. And I think that applies in all aspects of investing. And with HMOs particularly, I'll often say to people, particularly if they're moving into HMOs from single lets, which are relatively hands-off, and particularly if you have them managed. Single lets, you'll often have tenants for long term, you don't have to worry about bills, voids as much, maintenance, and they're relatively hands-off if they're fully managed. But the returns aren't fabulous. You're really looking at long-term buy and hold with single lets. Just sit and wait and hope they give you a decent pension later. HMOs, I think, are the opposite side to that. The returns, realistically, you should be looking at double digits. Don't look at HMOs if it's single digit returns. So you should be looking at double digits. But I always liken it more to being like a job. So you've got a constant turnover of tenants, even students, they're there for 9 months, then they're off, and then you've got to replace them again. Your professionals are going to be coming and going, your working tenants are going to be coming and going. You've got higher maintenance, higher repairs, bills to cover, all of the hassles with that. And effectively, you've got a job. but it's giving you those returns. So it's back to this scale that I often refer to, which is you've got your returns which are higher, but what is it that I'm losing in return for those higher returns? And basically it's your freedom, your passive income. Yes, you can get a managing agent, of course you can, and you can do all of those things, that's absolutely fine, but essentially you're probably going to be paying them a lot more, so you're going to be giving up something in return for those returns. So that's fine, just as long as you understand what those things are that you're giving up to get your higher returns. And if you don't want all of the hassle and to take on effectively another job, don't do HMOs and just stick to single lets. But I think a lot of people think that, you know, oh, I want the ease and no hassle of single lets, but I want those double digit returns. You can't. You've got to give up something and or sacrifice something, or it might be risk, as you say, taking on bigger projects. And what I would say, I agree with you, Grant, it's very, very rare to see people pull out all of their money on any project, to be honest, whether it's a refurbishment, a HMO or anything. HMOs, because you can see those significant uplifts and hopefully get some sort of commercial valuation if it's a big enough project. You may see people get very close to it. But also think about this, and it's back to our one with the valuer who commented, for lending purposes, this is the valuation. Lenders want to see that you have some skin in the game. Yeah, they've learnt, particularly from the pre-credit crunch, of allowing investors to pull all of their money out, that when they've got nothing invested in the deal, it's very easy for them to just hand over the keys, to walk away, to not make the payments and to let the property be repossessed. But if you've still got money in that deal, it is a fact that most people will work harder to keep that deal going, to keep it viable, and spend more time and effort on it. And the lenders learned the hard way from that in 2007, 8 and 9, and still are, learning the effects of that. So they've changed their policies a lot. They're a lot more cautious, and they want to see that you've got some skin in the game. As a rough ballpark, leaving in about 10% of your total spend would make a lender feel comfortable. Your numbers will probably work out, and you've got more chance of getting the valuation and the lending that you want. So if you bought property for 150, spent 100 grand on it, including all of your costs and everything, that's 250. If your valuation came in, I've got my calculator in front of me, let's say 350, and you get 70-75% of that, you're probably going to find that you're leaving in around, what's that, 225 grand, 30 grand, something like that, about 10% of your total spend. And lenders would feel quite comfortable with that, and you'd be surprised. They're not daft, they do the maths, and they will be having a look at how much you've spent, how much is you're leaving in that deal. And if the valuation comes back in the right ballpark and you're leaving a bit of money in that deal, then you're going to find that your lending is going to be a lot more achievable. But if you're trying to pull out all of your money and some on top, that's where you're going to struggle, because what you're going to do is you're going to push the valuation too far, probably cheese off the valuer who's going to say you're having a laugh, cheese off the underwriter who's going to say, well, why would we give you all of your money back out? And therefore just not get the result that you wanted. So be sensible. Think about leaving in about 10% of your cost of funds. It's the property investor's dream to want to pull out all of your money and go on and do the next one. That's how we all grow our portfolios. But the reality is that's one, hard to do, and two, actually doesn't happen that often. And I would pay no attention whatsoever to people who tell you that they've done it on Facebook and all of this sort of stuff. Believe me, I see the numbers on a regular basis. I see the offers on a regular basis, and what people say publicly to the reality are generally two completely different things. So just concentrate on your own deal, work on leaving in about 10%, and most times that should pan out.
Yeah, no, completely, and that tallies with my experience of these things. And I think if you want to have the cake and not eat it, you're best just doing your projects and then selling it, because invariably you will get a much higher valuation in the marketplace. If it's a good product, it's running and it's in a good area, you will get a much higher valuation than risk-adverse lender is going to give you in the context of lending you money. And that's, you know, quite right, because the last thing any of us want is a return to 2008, 2009. And yeah, it's skin in the game is the thing, isn't it?
And I've said that to so many investors over the time, not just with HMOs, but any sort of developments and conversions, and even refurbishments, where I've gone back and said to them, if you genuinely think it's worth more, just sell it. Take your money out, get it, and go and put it into something else, or do another project, or put it into something that would make a more sensible investment that you can, you know, see all of your money return. Put your money where your mouth is, really, is what I'm saying. If you think it is going to sell for more, us going back and appealing to the valuer and getting other lenders and other valuers involved, more than happy to do it, but it very rarely pans out. So if you genuinely think that property is worth more, flog it, take your money out of it, and go off and do another one. Yeah, I give that advice to people all of the time. Take the money out of it. If it's genuinely worth more, let's just not flog a dead horse, and then go off and do another project, and you know, get the numbers different next time around.
Yeah, completely. And sometimes people may be in a position where they have to do that because they need the money in order to pay back relatives or bridging finance or what have you. But on the other hand, if you're in it for the long term, then there's a good argument just to keep it and keep your money in, and, you know, enjoy that long-term income, hopefully in perpetuity. I guess my experience of it, I've got 4 properties all on the same street, which I did all in the space of 18 months or so. And they were similar sizes to start, and they were similar sizes when we finished. So typically there were 3-bedroom properties that we converted to 6-bedroom HMOs. And I met the valuers each time. So I had 4 different valuers, and it's quite interesting you mentioning those 4 different matrices, because it's subjective, is it not, Lisa? And a lot of it is going to be dependent on the surveyor on the day and how they interpret it. So am I right in suggesting that it's really a question of hoping for the best, but planning for the worst?
Oh, definitely. I mean, we talked about those 4 metrics. There's number 5 in there, which is the mood of the valuer, you know, which none of us can help predict, and certainly can't use a calculator to work out, I wish. But you've also got that the valuers can even be under instruction from the lender as to how to value HMOs. I've helped lenders with HMO valuation methodology, and they all have different methodologies. Some lenders, for example, even though they lend on HMOs, will only ever give a bricks and mortar valuation. They just do not give commercial valuations, full stop. Then you've got some lenders that only ever give a commercial valuation. And then you've got some that will create hybrids, and you've got some that will up value if a property's in an Article 4 area. So that's your 3 to 6, your small HMO, where you've had to go for planning permission or certificate of lawful use. Some of the lenders will up value because of that, but I've actually seen valuers down value properties in an Article 4 area as well, because they regard them as having less value and less appeal for having HMO planning permission. So it can backfire on you. Similarly, I've seen valuers comment where properties had all en suites put in, that it's devalued the property as a family home, so they valued it less than comparable bricks and mortar properties. So adding in the en-suites, getting planning permission, things like that doesn't always necessarily equate to the valuer agreeing with you and saying, oh yeah, you've added value to this property. They can actually see it as a negative and down value the property accordingly. But the mood of the valuer is so significant, and just, you know, some of them just don't like investors. Some of them don't like HMOs. Some of them are just having a bad day, like all of us. And then we go back later and effectively tell the valuer that they're incapable of doing their job. And none of us likes to be told that we're incapable of doing our job. So when we appeal, when we've got a valuation that we don't like, and I say we collectively as investors, is that you're going back and telling somebody that they haven't done their job right. That's never going to go down well, and that's why valuations are very rarely successful at the end of the day. Plus you need really good comparable evidence. But I think it helps to have an information pack available for the valuer. If you've got comparables, particularly if you've got other HMOs in the area, yours is great, having like 4 in one street, number 4 is an easy one to value. So if you've got comparable evidence of other properties that have sold, rental valuations, schedule of works, information from local agents. Remember, they prefer sold. They don't like properties that are on the market for sale. They would typically ignore those comparables. They're looking for sold prices. If you've got a rough idea, as I said, as to what value HMOs go for 4 rooms, 5 rooms per room sort of value, put all of that together, but judge the mood of the valuer before you hand over that information. Some of them really friendly, really helpful, and quite frankly will go, great, this has saved me a job. I've got all of this information. I just have to go and check that it's all accurate. And then you've saved them a couple of hours work in the office, and they'd be more than happy to have that information off you. Some of them, however, feel that you are telling them how to do their job. And that's their job. That's what they've been paid for. They're qualified. They've got qualifications that enable them to do all this. And the last thing they want is jumped up property investor giving them an information pack. So I've been there myself. You do have to judge the mood of the valuer and whether they're going to be receptive to taking the information. If you're just not getting that vibe, I seriously wouldn't bother. But if you do get an opportunity, make sure you have it available there, and that they're not having to come back and ask for it later, because they'll go back to the lender, then they'll go to the broker, then we have to go to the investor, then we have to pass it back again, and that all delays things. So if you do have it available, just mention it to them, depending on their mood, offer it and just say, I've got some information here. Don't sit there going through everything with them and trying to persuade them that your house is worth 50 grand more than anything else has ever sold for in the street. Just say, I've got some supporting documentation here. If you want it, you're more than welcome to take it away with you, and just leave it there, or just leave it on the side. And if they take it, they take it. But I wouldn't push it. I wouldn't go over everything with them with a fine tooth comb. Just leave it and see whether they take it or not.
I think that's great advice, Lisa. I've had experience on one hand. I met the valuer at the property. This is a different property, so not one of the 4 properties in the street I mentioned earlier. And the guy was a little bit blank. He was asking me all sorts of questions, and I had the answer to some of them, but I didn't have the answer to a lot of them. And I have to say, looking back on it, he was struggling. I could see him thinking, how do I value this property? And he almost wanted me to give him the answer. Fortunately, he had a number on a piece of paper somewhere, because when we applied for the mortgage, we had to give a valuation. And I remember the advisor at the time saying to me, Grant, the important thing with this is to be a little bit bullish, but be cautious with it, because if you put the valuation too high, it raises an alarm bell. The surveyor's going to think, this can't be right. I'm going to have to find out what the valuation is. But if it's more realistic, yeah, be a bit more bullish, but a bit realistic, and it seems about right, then you're going to be more than halfway there in terms of getting what you want with a tweet. And in this situation, this individual just, he saw it, it looked slightly bullish. He just wanted that little bit of affirmation from me. And luckily, I did the important information that I did have available was what I bought the property for and how much I had spent. And I gave him those figures, and they came back, fortunately, with an addition of those 2 numbers, which is pretty much what we find generally across all our projects, is they will come back, give or take 5% either way, the property or the value and what you spent. So it's exactly as you said, Lisa, the important thing is the information pack, which we put together now every time. We have, if we've let the rooms, we have the signed tenancy agreements. If we haven't let the rooms, we have evidence of what we feel those rooms can let based on other rooms we have, or data available on something like spare room. We have detailed analysis of what we spent on the project. Now, remember to include everything. So you can include your travel, you can include fixtures, furnishings, all of those things. The surveyor may look at it and say, well, I don't want to include this, I don't want to include that, and that's their prerogative, but they equally may look at it, they may just look at the overall figure, put the two together, and be happy with it. So it's really important to have that information. The other example is, again, met an individual on site, had everything prepared in the folder. They looked at me and they didn't want to know. And I think it's really important to back off in those situations, isn't it, Lisa, and just let them get on, because no matter what you say or do, they just want to do it themselves and make their own mind up.
Absolutely. I've had one personal experience with one of my properties. Was I've very rarely said that I was actually the owner of the property. It was far easier just to pretend you were like a property manager, let them in, let them wander around and just ask you any questions. And this was a really interesting one, actually. Went to a property, let the guy in. He just assumed that I was just a property manager as a letting agent. And he absolutely started berating property investors, saying he couldn't stand them, they were stealing houses, he couldn't move up the property ladder because they were taking all of the properties that he wanted, and all of this lot. Just he didn't know I wasn't a property investor, but he didn't seem to care. And he said, I noticed that this is a buy-to-let lender. He said, so this must be a property investor. And he went, nothing makes me happier than downvaluing a property investor's property. Ha, 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 like that, like, evil sort of laugh sort of thing. And he actually said those words to me. And as I say, it was my property, but he didn't know. He just assumed that I was a property investor. I'd like to think he's a rarity, but that's my own personal experience that I actually had of a valuer who said he deliberately downvalued anything that was for an investor. So those experiences unfortunately do cloud your judgment a little bit. One of the other things that I was going to say on valuations, which I see a lot, is people saying about, can I arrange my own valuation? Or you'll see people on the groups and that, I'm sure you've seen it lots. Does anybody know a valuer in this area who does HMOs or whatever? And typically it's investors trying to get a feel for what the property is going to be worth before they actually put it in for a mortgage. There's a couple of things with this. Firstly, even if you ended up with the same valuer, and I'll explain why you never will do, but even if you ended up with the same valuer, you could still end up with two different valuations. Okay, when the valuer is working for you as the client, you're going to be saying to them, oh, I think this is worth 350,000, blah, blah, blah. And he's going to go, okay, then you're the client, you're paying for the valuation. If you want 350 val, it's no skin off my nose, that's what it's worth. And the chances of you suing that valuer are actually very, very slim. You probably couldn't afford to for a start, and his PI will pick it up. And why are you going to sue him if you've got the valuation that you hoped for? If, however, he values the property for a lender, and that lender ends up having to repossess and potentially lose his money because the property was downvalued, he could lose his license, he could lose his PI, he could lose his entire business. So they could be valuing the exact same property for you and for a lender and give two completely different valuations. And I've actually experienced that myself personally, because their liability to the lender, they deem that as significantly higher than their liability to you. Now, that again used to happen before the credit crunches. You could get a valuer to go out, value it for you, and then value it for the lender. That will not happen now. It would be deemed to be a conflict of interest. And if you read your valuation reports in depth, particularly the full form long commercial valuations, it will say that they've not viewed the property on behalf of anybody else or valued the property on behalf of anybody else. There's no conflict of interest. So you would not get a valuer that is going to value a property for you, and then when they get a call for the valuation, would then go out and value the property for the lender. So even if they would give two of the same valuation, which they wouldn't, they are actually not allowed to value the property for you and for the lender. So you're never going to end up with the same valuer anyway. And where this can backfire, I had a client who had done a HMO, large HMO conversion. I'd asked the local valuer to come out and value the property for him, so he'd got a rough idea of what to put it in for the mortgage. And lo and behold, the lender contacted the same valuer because he was the HMO expert in the area. The valuer had to say, I can't attend because I've already attended and valued this property on behalf of the owners of the property. So the valuer had to call in a different valuer. Unfortunately, the next HMO specialist valuer was from about 80 miles away and didn't know the local area. He openly admitted that, but unfortunately, the borrower, the client had scuppered their chances of using the local expert and got a different valuer to come in, and he downvalued the property by 100,000 and wouldn't budge from what the other valuer had actually valued for the client. So it can backfire really badly, unfortunately. It's quite a, it's probably a rare example, but I would just be careful about arranging your own valuations. You're going to be paying out a lot of money to arrange a valuation that, in all honesty, could be completely different from the one that you're going to get from the lender. So I always go with exactly what you said. Be a little bit bullish. Give the valuers some wiggle room. They like to say that they've been through their numbers and that they've done their job and knock off a few grand. Yeah. So give them, be a little bit bullish, but give them some wiggle room and hope to end up back where you want to end up. And that's the best way to approach valuations. But going and getting your own done or arranging independent valuations, it's probably just a waste of money, in all honesty. And also getting valuations from estate agents. They're generally very bullish on valuations for HMOs, and like we've demonstrated several times, the market price, what it might sell for and what might go on the market for, can be very different from the actual valuation for lending purposes.
Yeah, I think that's good advice. I mean, estate agents at the best of times are definitely bullish. And that's interesting because I hadn't thought about having your own surveyor coming and doing a valuation. It's something I've never done, but I can completely see how they're going to be far more risk adverse if they're valuing for a lender than they are if valuing for an individual. And I think what all of this leads back to is, again, the old adage is we've got to hope for the best, but plan for the worst. And just when we're doing our finances, just have everything based on a best case, worst case scenario, or reasonably worst case scenario, and have an accessible contingency in place for the worst case scenario if that comes about. And I think with all of these things, and what I say to people who are getting into HMOs and doing HMO developments is that some are going to go your way, others won't. Some will be in between the two. And it's just the more you do, the more even everything will be. And if something's been unfair to you once and you do it again twice, it'll all balance itself out, hopefully. So it's just about that longevity. One of the things we didn't, because I was going to ask you a question actually, and you pretty much covered all of the points in terms of what can we do to ensure we get as favourable valuation as possible. And I've kind of ticked them all off, but I think one of the things we didn't cover, Lisa, is when the valuer comes to the property, because there's a sweet spot, isn't there? So when the property is brand new, looking good, and I'll let you talk more about the importance of it being finished. But from a perspective of it looking good for us, we try and book the valuer when the project is finished, but before anybody's moved in. So they can see everything there. It's nice and spacious. There's no tenant belongings and anything else. So it look as crisp and clean and as favourable as possible, just to get that, squeeze that little bit of extra emotional value from the surveyor. But it's also important that the project's finished for other reasons. Is that not right, Lisa?
Yeah, I completely agree. I often say to clients, contact us when the carpets are going in. So you've got a bit of lead time with getting decision in principle or heads of terms, and then the application in, and then underwriting, waiting for the valuer to get called out. So once the carpets are going in, you've got a couple of weeks lead time then for hopefully get the carpets in, get all of your furniture and your fittings in. And as you say, before the tenants move in with all of their dirty washing and all of this sort of stuff, and ruin the place. So definitely that sweet spot. Obviously, if it's a remortgage and the place is fully let, then there's not much you can do about it. But if it's a new refurbishment or conversion, then that point just before your tenants are moving in is great. Lenders don't require that the property's fully let. I have seen it on occasion where the valuer might have commented that they don't expect that it would let easily. So we have seen the odd lender who's come back and said, when the property's fully let, then we're happy to consider it. But that's rare. It's not a requirement for most lenders to say that the property has to be let. So it can still be at empty stage and it can still be available for let, or you've got your tenants moving in at the end of the month or something like that to be let. So yeah, that sweet spot of the property looking at its best is great for the valuer to go out, plus accessing rooms. So there's two things here, is the valuers need to be able to access all of the rooms, and if you've got tenants in there and they're on shifts or sleeping, or they've locked their rooms and you don't have a key, then that can be really difficult, because some of the valuers might accept it, but quite often we've seen them reject a valuation or put a nil valuation on it because they couldn't get access to the rooms. And then they have to go back, which you might have to pay for them to re-attend. So having access to all of the rooms is key. Again, if you get that sweet spot before all your tenants move in, you're going to be able to cover that off. The other thing is making sure that all of the work is done and completed. The reason behind this is that, particularly if it's a remortgage, which is these typically are that we're talking about, lenders will often have indemnity policies that enable them to skip some of the work. It might be searches, it might be having a full commercial valuation that they don't need to have that done. They can just have a re-inspection by the valuer who went out the first time. Bridge to term would be a good example of that, where the valuer has just gone out and confirmed that all the works have been done, rather than doing a full long form report. There could be all sorts of reasons. It could be using in-house legals instead of you using your own legals. And these indemnity policies will often come with quite strict terms. And one of the common terms is that the property has to be 100% finished and completed. And if the property isn't completed, then they can't use that indemnity insurance, and therefore they can't basically complete on the loan or provide the legals or provide the short form valuation. So we've seen cases rejected or had to sit and wait for things like rendering on the outside of a property. A small piece of render hadn't been finished, so the valuer said property's not completed. Had to wait until he could go back out after the rendering was done. I've seen this for some tiles just around a shower in an ensuite, where the valuer took a photo and commented that the tiles were still to go in. They're not doing it deliberate, they're just pointing out that there's elements of the property that aren't finished yet. That went to the underwriter. The underwriter came back and said, unfortunately, we can't sign this property off as 100% complete. Valuer needs to go back and confirm it. I've seen it happen where there was a skip on the drive with all of the rubbish still in the skip on the drive. Valuer took a photo of the front of the house. There's a skip with all the rubbish in. The lender came back and said, until the skip goes and all the rubbish is gone, we don't regard this as a fully completed refurbishment. We can't lend on it. Valuer will have to go back out again. A couple of hundred extra costs, delays everything, blah, blah, blah. So making sure that the property is fully completed before the valuer goes out and everything is done, all the rubbish is gone, all of the inside and the outside work is completed, is really crucial, because otherwise it's just going to delay your application. The valuer is going to have to go back out, and that's going to cost you more money.
Completely. And I've been in a situation like that, thankfully only once, where I had to be rescheduled, but I learned from that. And I think it's important just to remember that if you book the surveyor in, it can always be moved. So we've had surveyors booked in, and often with any development project, with any property, things always get behind. And even if it is just a question of a little bit of rendering or a skip, or the driveway needs doing or finishing or something like that, whilst it probably isn't going to be a problem, it could be a problem. And for the sake of an extra week or a week or two, just pick up the phone, drop them an email, move it to another date, and it's never a problem. And we often have to do that, but it allows us just to manage a little bit, because if we wait too late, we then know the surveyor is going to be coming after the tenants have moved in. So we'd rather be too early, knowing that we can just nudge it forward accordingly, just to help us hit that sweet spot.
On that point as well, really, really important point. Can I just ask everybody listening to get the contact details for the surveyor or the valuer when they contact them? There's a general misconception that brokers are, one, told when valuers are going out, which is we often aren't, and two, that we have a direct line to them. We generally don't even know which company it is that's going out, let alone being able to get hold of them. So if you haven't taken the valuer's details and can contact them and say, can you come a week later, or can I rearrange, or there's some tiles missing, is that okay, or do you want us to get it finished, or any reason, or I've run over the dog and I need a week off, any reason at all, please take the valuer or the surveyor's details when they contact you, and make sure that you can get back in touch with them. Because if you come back to your broker and say, oh, I can't make tomorrow morning at 9 o'clock, can you let the valuer know? No, we generally do not have a clue which even company is going out, let alone the individual valuer. And what we would have to do is we would have to go back to the lender. I would say at the moment, unfortunately, lockdown, COVID, all of that is still having a major effect on us contacting lenders. Some don't even have phone systems. There is no way to contact them by phone. Those that do, being on hold for an hour to 2 hours is not unusual at the moment. So we have to phone the lender and then tell them that you can't go. They then have to contact the surveyor or the valuer. Sometimes there's a panel, an instruction panel in the middle, so they have to contact them first. Then they contact the valuer, say to the valuer, don't go tomorrow at 9 as planned, might all be too late by then, and they've turned up, in which case you are going to get billed for it. And if they have to go back out because they can't attend it, they are going to charge you again. So please, biggest plea of all, take the contact details for the valuer and the surveyor when they get in touch. And if there's a problem, get in touch with them directly. Don't go back through the obviously not if you're appealing the val or anything, that's got to come back through the broker. But if you can't attend, or there's a problem with you attending, please just contact them direct, or contact the panel that contacted you. You might have like a PA service or something that contacted you. Get their details and contact them directly, because to go back through the broker and the lender and the panel will take ages, and that's even if we can do it in the first place. It sometimes just goes into a black hole, and we've had valuers turn up even though we've told them that they can't because the client's not going to be there, and then, as I say, we start getting into arguments about who said what and who's going to pay for what. So yeah, that would be my big plea.
Yeah, I think that's good advice. And I've been caught out many times from not being able to contact the surveyor and getting really frustrated, wishing I'd written down the number or kept the email or what have you. It's benefited us as well in certain situations. So they're not obliged to do this, but we were wanting a valuation for, I think not the last project we did, but the one before, and it just took ages. The broker didn't know, the bank said the report hadn't come back, and I had the guy's number and I just called him, and he just said, oh, I sent the report back, I don't know where it's gone, but I gave valuation X, based on these things. That's perfect. So verbally, I had the information I needed, and we could all begin to sleep at night.
Yeah.
So it was helpful in that instance. But Lisa, I think we pretty much covered everything. It's been really, really informative having you just to go through all of these things with us. For anybody viewing this podcast channel, we can drop your contact details in, but what is the best way of people to get hold of you, Lisa, should they want to have a chat with you?
Google me, to be honest. So if they Google Lisa Orme, I'm on, I've got my website, keys-mortgages.com, they'll come across that. I'm on Facebook groups, Facebook. I've got the Mortgage Mama brand, as I say, that I'm doing at the moment across my various social media channels. You go to Apple Podcasts, Spotify, and look for the Mortgage Mama podcast, you'll find me there. And then if anybody's interested in the consultant side of it, if they go to lisaorme.co, so lisaorme.co, and that's my consulting business, and there's all information on there. But basically Google Lisa Orme and you'll find me on all sorts of places.
Awesome. Well, thanks again, Lisa. And thanks for joining us, everybody. For more podcasts relating to HMOs, do visit our website, hmosmatters.co.uk, or subscribe to our YouTube channel. And Thank you for listening.